back to that portfolio diversification, everybody's chasing yield. So you need a mix, in my mind, whether you call it real estate, alternative investments, high yield, something that's a little riskier in your portfolio to keep that average return above the inflation mark. If you're going to get a 5% return over the next 10 years, you're not keeping up with inflation and stuff in the long run.
Welcome to Personal Finance Cat, where I share my personal take on personal finance. Hi, Randy. Welcome to the show.
Good evening, Handy. It's a pleasure to be here, and thanks for the invitation.
Of course. Where are you currently? You're in a vacation house?
I live in Houston, Texas. I'm at a lake house in Lake Erie, Ohio, along the lake and Lake Erie. It's called Lakeside,
Nice.
along Lake Erie, though. Yes, beautiful weather here.
Yeah.
For my friends in the Southwest who are struggling with the heat, about 68 degrees today, low humidity, beautiful blue skies,
Nice.
and a lake view. So
Perfect. So are you there for pleasure or business or both?
pleasure. I'm from Ohio, relocated to Houston. We can get into that story for business purposes, but I'm from the Ohio region, and this is home, so we're just here vacationing.
Nice. Great. Thank you for taking time during your vacation to speak with me.
Not a problem.
So maybe let's start with your journey to this point. I think I understand that you're a multi-family or commercial real estate investor. Can you talk about how you came to this point? What were your prior experiences and how long have you been in this space?
Happy to do that. So Randy Langenderfer, currently reside in Houston, Texas. I am today. I left the corporate world a year ago to focus full-time on multifamily, a specific asset class within commercial real estate, investing purposes. My journey started about 10 years ago when I was working for a private equity company, Carlyle Company. If anybody's heard of them, they're a large private equity firm.
Mm-hmm.
And I was working for them and was really concerned that I was going to lose my executive position not because of performance, but just because of finances and state of the union of the company, as they're famous for. I was fortunate to not get laid off, but it really made me focus on the need to find another stream of income, a passive income stream. And since I was focused on a short horizon, 9 years or so, 10 years to get out of the corporate world, it really focused me to find another income stream. And so I looked at buying small businesses. I looked at franchise opportunities. I got a brother-in-law who got me involved in single family flipping houses. I was living in Ohio at the time. We were flipping houses in South Florida. We made some decent money. I relocated to Houston for a W-2 job, and there I found multifamily, and I just really fell in love with the asset class because everybody needs a place to live, non-recourse debt, and the advantage of syndication, of forming a syndication of investors to go out and acquire a large multifamily unit that none of us could buy individually. And so it just fit my personality, and I'm able to do what I want to do today, and I'm thankful for it. And so here to help your listeners understand, one, the asset class, two, that if I can do this, anybody can do it. It just takes a conscious effort and a desire to do so.
Yeah, that's awesome. I think what you described probably fit in the profile of a lot of people I know. And I think I'm personally also on that journey to figure out what other passive income streams can ultimately replace the W-2. I've looked into small businesses just like you, franchises, or even just mom and pop businesses. And I've done some real estate, both single family and small multifamily. I haven't ventured into syndication or large multifamily for whatever reason, but I'm just wondering what made you take that leap of faith. I guess you mentioned that there was this concern about your job being
Yeah.
eliminated. But how were you able to just so quickly transition from being a W 2 employee into these different ventures that you
Yeah,
described?
I think there were a couple things that were attractive to me. One, I'm a finance accounting guy at heart. I'm a CPA, MBA, and so I'm risk adverse for the most part.
Uh-huh.
So I didn't just start throwing money out there, my own money. I really educated myself. I joined multifamily educational groups. There's many of them out there today. I've formed my own recently to get educated and understand the risk, because that's the difference between um, uh, investing and just throwing money at something. So I invested, I educated myself. I began to dip my toes in the water by investing in it. I learned that I didn't want to do single family, no disrespect to those who did, but it's just difficult to scale. I
Mhm.
learned very quickly that to have 50 or 100 rent houses is an enormous amount of work, where if I have one multifamily that has 100 units, I can hire professional management, maintenance people, et cetera, et cetera. So I became very interested in one, the ability to buy large assets on non-recourse loans. So that's the beautiful thing as compared to buying a business or a franchise. If you have to borrow money, you're taking a loan out that is recourse. In other words, if you were to default, the lender could take your other assets. And in multifamily, it's a non-recourse loan. So in the very worst situation, if we were to default, we'd lose our investment, but the lender couldn't come at us for my personal assets, my home, my automobiles. And I had just been in an executive position, was able to save some money, and I really didn't want to lose it. So that was one of the big drivers for multifamily. And
Mhm.
then I could do it part time, so I didn't have to quit my W-2 job. I could scale as I felt comfortable with. So I dipped my toes in the water with one investment, two investments. About 4 years after I started to do it as a limited partner, I became, first time I was a general partner, which means we found the property, we took the risk to get it under contract, found a loan, brought the investors together to buy the property. So it was really a good 4 years before I did that. And it was another 5 years after that before I gained comfort with and actually leaving the corporate world. So it was not something that's done overnight, but it can be done very methodically.
Mhm. So it sounds like it has been a while since you have tried to invest in real estate. Somehow I thought that at the beginning you mentioned that it has only been a year or so. So that 1 year is only since you've started on your own?
That 1 year is since I left the corporate world.
Oh, I see.
That's when I formally left the corporate world and cut the purse strings and all the risk associated with it and all that stuff. Because, as I said, I'm kind of risk adverse. I wanted to make sure, I could feed the family and
Yep,
have a place to sleep and all that good stuff.
yep, yep,
But
of
so
course.
it's only 1 year from leaving the corporate world. Actually, 9, 10 years of doing this.
Gotcha. So at first you were a limited partner, just investing passively. You probably learned how to do this from just interactions with the general partners, and then you decided to take the leap of faith and started becoming a general partner yourself. Is that right?
Exactly. Yeah. And so it was, some people jump in head first and become a general partner right away.
Mm-hmm.
Some people have a motto of go fast, go big, go fast. I wanted to go methodically, slowly, and securely. So that's just the course I took. Other
Mm-hmm.
people go a very different route, but that's just the course I took from where I was at, from a risk mitigation strategy. Um,
Mm-hmm.
so I come from a corporate world, so I kind of think that way, and excuse me, risk mitigation and how that might um, be beneficial for me.
Cool. So you mentioned that you looked into franchises as an example. Did you do anything with that as well, or did you just decide that real estate is the way to go? And if so, what made you make that decision?
the biggest one was when I looked at franchises, I really got excited about Chick-fil-A franchise
Uh-huh.
because at the time, this was 10 years ago, it only took $5,000 down because you're not really an owner in Chick-fil-A, you're an operator.
Hmm.
But I was in their process, but they have tens of thousands of people that apply every year, and only like 5% get an interview. And then after that, it's a very small percentage that get a second interview and a third interview. And so it's a minuscule person that really gets to go forward. So I was fortunate enough to get a first interview, but I never got past that. I looked at other franchises. I looked at Panera Bread franchises, but that took $1 million at the time. It's probably
Wow.
much more today. And so I did not want to invest every penny I had in that for all the reasons. And that's when I found multifamily. And, it's a great passive income stream. You can be as active as you want. You can be doing what I'm doing, or I talk to a lot of people that want to have real estate in their portfolio, but don't want to deal with, as we call, tenants, toilets, and termites,
Hmm.
or all those issues that go with it. And so they can get a very healthy return
Hmm.
by just investing passively. And that's great too. There's a lot of people I know that do that.
Hmm. Hmm.
So it's just a matter of how active the investor wants to be.
Yep.
And I I also you primed the pump, so I'm sorry. So you got me going. The other one I always talk about is I came from the corporate world, and so my last employer here in Houston was a large academic medical institution, and we had a 1.5 billion, that's with a B,
Wow.
dollar endowment. And I talked to the chief investment officer a lot, and they had really morphed into, they had the traditional asset allocation model of stocks or equities and bonds, a mix of equities and bonds, which is pretty typical in what they teach in every place, diversification by those. But really that endowment had morphed into equities, bonds, a line item for alternative investments, and a fourth item called real estate. So if you look at your big portfolios, they're going to have a portion of their assets in real estate, commercial real estate products. And for my previous employer, it was anywhere from between 8 and 12% of $1.5 billion. So I bring that to your listeners to say, really, everybody should consider having real estate, some portion of their portfolio in real estate besides just their primary residence.
Hmm.
So it's a great inflation hedge, cash flow, tax advantage, and forced appreciation are really the reasons that you do it.
Yeah, that's a great summary. So I definitely agree. I personally invested in real estate, like I mentioned, and there are a lot of advantages as you described. But my main concern with where real estate is at now is the high interest rate for getting a
Mm.
mortgage. How are you able to, or how have you been able to deal with that? Are you kind of raising more down payment or just trying to find really great deals? So, how are you handling kind of the high interest rate?
Yeah, I I've been talking to several investors the last couple of weeks, and that's on everybody's mind.
Hmm.
You hit it on the nail. I mean, nail on the head. How does interest rates affect it? And it does. Obviously, people are smart. So a couple of different answers to that is one: if you bought anything in 2021 or 22, you bought it on variable rate debt, and those are the ones that are coming due to renew those or extend those first 3 year loans. Every property is unique. So many of them have challenges. Many of them are doing just fine because the cash flow supports it, and the properties are appreciating. So in that vein, if the property is cash flowing and appreciating, it's gonna hang with inflation and eventually beat it as inflation begins to moderate, or interest rates begin to moderate. And so I'm of the opinion it's kind of like, when's the best time to invest? Either 20 years ago or today.
Hmm.
And if you invest today, you're just investing very differently. So to answer your question, I'm not buying anything that has variable rate debt in it today. I am buying properties today. We bought one last year, and we're in the process right now that I think are very different. So one is a portfolio of properties in the Houston, Texas market that has a really nice tax abatement issue. So for your listeners that aren't from Texas, Texas reappraises commercial, all real estate for tax purposes every year. And so your real estate taxes fluctuate significantly. And so there's a program that you can get through the state of Texas with affordability clause in the tenant base. You can pay zero real estate taxes. And so that's a huge differentiating factor. So that's an example of finding a property that is unique and can beat the interest rate rises, because I'm taking out large expenses right away that help increase my NOI. Another one we're doing right now is a build to rent opportunity in North Dallas. And that's, for your listeners, those are just as it says, you're building to rent townhouses. So they're townhouses that are built just to rent versus to sell. And you're attracting a different type of tenant, one that's there by choice rather than by necessity.
Mm-hmm.
This is a 1,600 square foot townhouse with a garage, a patio, a small backyard, amenities like an apartment with leasing offices and dog parks and tennis courts and pools, etc. So, and it's in a great area of North Dallas, Melissa, Texas, where the macroeconomics it's crazy growth. It's just crazy growth. So that's how I'm trying to differentiate, and how to beat the interest rate is trying to find unique opportunities for investors and myself that I think in the long haul will be able to mitigate that interest rate rise.
Yeah, that makes a lot of sense. So it sounds like really the special opportunities available in the area that you're in is kind of the way that you try to deal with this high interest rate environment. But is that the reason why you moved to Texas, just to be local and then be able to understand and obtain these opportunities?
I wish I could say I was that smart, but I'm really not. I really moved to Texas 10 years ago for a job opportunity because I needed a job to continue my
Oh, yeah.
career.
Mm-hmm, mm-hmm.
And then that's where I learned about real estate. And that's where I mentioned I'm from Ohio.
Mm-hmm.
So anybody from the Midwest, I hope I'm not disparaging you, but there's a big difference between the Sun Belt, those areas across the southern U.S., and the Midwest specifically, where you mitigate risk because there's investment risk, because there's a large population influx and there's a lot of job opportunity influx with high paying jobs. So that's another reason why I fell in love with Texas. Today it's no secret. Many people feel the same way. The Carolinas, the Floridas, the Arizonas, the et cetera, et cetera.
Yeah, exactly. I think you're kind enough to call out the name, the Rust Belt. But yeah, because I I invest in Indiana, so I know that the Midwest,
Mhm.
you can find properties pretty cheap, but they don't have appreciation, and like you said, the rents also don't go up that much because the population is typically on the decline. So it's really hard to build that into your numbers and try to
Well, and that's
work.
that's an example, though, that there are opportunities everywhere today. There still
Mhm.
are. There are opportunities everywhere, and you're local to that market, or you know that market much better than I do.
I'm
So
not
I'm
local, but
sure.
I'm just investing in that market.
Yeah, okay,
Yeah.
but you've studied that market, you know it, and I have a lot of friends. I'm from Cleveland, Ohio. I
Hmm.
have a lot of friends that invest in Cleveland, Ohio.
Hmm.
Um, and again, I'm from that area, but I'm just not ready to do that yet. It's just everybody has a different investment profile. So that's, again, nothing disrespectful for my friends in Cleveland, but I just find it's easier to mitigate risk in the South, where there's higher job opportunities and population migration to the South. The population growth alone in Houston is just staggering to me, and but I don't think that's bad. I know a lot of people like yourself that invest in the Midwest, and if that fits their investment thesis, that's fine.
Yeah. Yeah, I definitely agree. I think despite all the drawbacks of little appreciation and rents being more or less stable, I think the advantage is the stableness because, as long as you buy the property right and you have, let's say, a 30-year fixed mortgage, then I think your cash flow is also going to be stable. So if that's what your strategy is, I think that works. So yeah, I agree.
And it's the same thing. I love multifamily for the reasons I stated, but single family is still a great place to be if that's what you want to do.
Right.
I coach people all the time.
Yeah.
It's easier for people to get started in a 2-unit or a single family unit than it is a 100 unit apartment.
Yeah. Yeah. Exactly. So you mentioned that you coach people. Can you talk about that aspect too? So what exactly do you teach people? Is it just the fundamentals, or do you teach more advanced techniques? Can you talk about
Well,
that?
thanks. Yeah, a colleague and I just recently started a program about 4 or 5 months ago. We're both recipients of what I'll call the big box multifamily teachers. There's many of them out there, national organizations that teach how to acquire multifamily opportunities. And they are big operators with big track records. My partner and I has been doing as long as I have. But so we say the big box. I relate that to the Home Depot of the world. If you go into Home Depot, you can find everything and there's everybody there, but it takes a while to find somebody to help you. Versus if I go into the True Value Hardware, somebody meets me at the door and says, "How can I help you?" And so our educational arm is how to help people find and acquire multifamily, but we think it's a much more personalized and hands-on approach. So we have a series of 11 courses, online courses that they can take, everything from dealing with brokers, how to underwrite, just every aspect of acquiring multifamily. We offer group calls once a week with my partner and I. You're not going to get some underling, you're going to get us. And we're making ourselves available to just provide a much more personal environment for those who want that, I'll say, hand-holding. And there's a part of me that kind of wishes I'd have had that when I started versus the large national groups. And that's, again, those are fine for people, but they're very expensive. We're at a price point that's much lower. And, if there's anybody on your call or on this webinar that would like to have a further discussion about that, love to chat with you.
Yeah. Yeah. That's excellent. But let's talk about your role in the current business, right? So it sounds like you have another partner, at least another partner. I don't know if there's a group of people who would do this together. So what is the division of roles and responsibilities?
So I have a partner for the mentoring / coaching business. I am in about 1,500 doors as a general partner today, 6, 7 different properties. And I have different partners. Some of them will overlap in each of those.
Okay.
And so that's the beautiful thing, again, because multifamily is truly a team sport. Single family, I can own a rent house myself, whatever, but it takes a group of people. And so everybody has kind of a different role in each of those partnerships. Some help just find the deal. I try to be very involved in the asset management. That's the involvement looking at the on-site property managers on a week-to-week basis. Some people are just capital raisers. Others of them are just signing on the loan to
Mhm.
meet the loan requirements with the bank. And so that's something your listeners should ask what the role of the general partner is. It's not bad. So the short answer is I've served each of those roles
Mm.
um, in those different ones. I'm a full-time. I identified the property. Uh, I'm, I'm asset management every week on multiple calls with the property managers in different parts of the country. I have served as a key principal. That's a requirement for the bank, just lending basically my assets as collateral.
Mhm.
Um, and so there are multiple different roles. And so that's because I've chosen bigger properties to go after. And what we coach is that you don't have to do everything yourself. It's a team sport. You need to find some people that accentuate your skills.
Mhm. Mhm.
So I'm the finance, the analytical guy. I'm the geek that likes a good spreadsheet.
Mhm.
Where I'm weak at is in the marketing. I don't enjoy that. I
Yep.
don't enjoy marketing the property and all the intricacies that go along with that. But I've
Mm.
got partners who are excelling like that,
Mm.
and that's really what you want to find. Um, and to really grow your business, it needs partners and the team sport aspect of it. So for those out there that uh, want to be a lone wolf, that's fine, but it's going to be challenging for you to really grow your business to something that's sizable. And if
Mhm.
that's okay with you, then great.
Yeah, no, that sounds great. I think it's great advice. One of the reasons I didn't go into multifamily syndication yet is exactly because of that. It was probably a difficult time when I started looking into it because it's right around COVID and just felt like things are difficult to do. But thinking back, that was a great time to start, much better than now. But anyway.
Yeah.
Mhm.
It's always a good time to start. No, don't. It just you may go a little bit slower. So I said the example I gave is I wanted to be in Phoenix. I wanted to have an asset in the Phoenix market. And I had gone there pre-COVID and several exploratory trips to talk to brokers, to talk to property management companies, to see assets, et cetera, et cetera. And it was really difficult for me to live in Houston, Texas, and get in something in that region.
Mhm.
Through a mastermind that I was in, I met a good friend and we talked, and over a period of about a year and a half. And then he asked me to join him in a property in Tucson.
Mm.
And so I today have a part ownership in a property in Tucson. Again, I joined with him because he had Tucson experience. He knew the property managers, he knew the vendors to ask for work um, that I could have developed, but it would have taken me a lot longer to do so. And
Mhm.
so it's easy now. I can go if I chose. I could go back to that market and say, "Oh, I'm in." I could talk to brokers and represent myself as an owner in
Mhm.
Tucson, which is not a lie and very accurate. Um,
Yeah.
so, and you can grow that way much quicker.
Yeah, that makes a lot of sense. So I understand that you have properties in a lot of different states. So besides Texas and Arizona that you just mentioned, I think there's also Oklahoma, South Carolina, and Louisiana, if I got that correctly. So how did you?
Louisiana and Oklahoma were passive investments. So, as an
Okay,
active or general partner today, I'm in Asheville, North Carolina, Tucson, Arizona, two in Houston, two in Dallas.
okay,
And then as a passive investor or a limited partner, I still invest in other people's deals, and I'm in several different regions, areas.
gotcha, gotcha. But regardless, how do you feel comfortable about certain locations versus others? What are the critical factors that you consider?
Uh, I go back to me. To me, it's I'm sure you probably heard the illustration of the horse and the jockey, right? And
Hmm.
in a horse race, which is more important, the horse or the jockey riding the horse? And when you convert that to the multifamily space, the jockey is the general partners, and the horse is the specific asset. So I believe what's most important is the horse or the general partnership team in a multifamily. What's their experience? What's their track record? What's their relationships? Their ability to close deals, the ones they've gone full cycle on. So the answer to your question is I focus on the Sun Belt from the Carolinas over to Arizona, and I look for relationships. And then I try to find deals that are different. As I mentioned, the tax abatement project last year and the build to rent this year. The Tucson project in 22, it was a 1969 build with 199 units. And most people would say that's too old and not, but that's the one that's performing best in my portfolio today because I'm not a genius, but because of the on-site property management team. That's just, so it's about it comes down to operations always of running the property.
Yeah, that's actually an aspect that I'm really interested in is how do you find good property management team? Maybe I don't know if in this case you just got lucky, you inherited this property manager, or how did you find this excellent
Well,
operating team?
I like to think it was more than luck, uh, but it wasn't much more than luck because, well, it goes back to again. I identified a partner that had a ton of experience in the area,
Hmm.
and he was using the property management company. So the long story is this was a 1969 build, 199 doors. He had bought a similar. My partner had bought a similar property from the same seller, the same vintage, 60 build, 1960s build, and had just gone full cycle on it. And so he knew that, with all due respect, the guy had owned it for 20, 30 years, and he wasn't looking at maximizing revenue. He was just trying to keep the place filled with tenants. And so his property management team was the same one that did the previous one. And it was a no-brainer, Andy, to just transfer to this current asset. Is that lucky? Is that smart? I don't know.
Combination of both.
Combination of both.
Yeah, yeah. Okay, that's great. I think one thing that comes out in your bio is also the community. It sounds like maybe building a community through owning multifamily is a mission of yours. Can you talk about that aspect? Is that one reason that you like this asset class?
It is because I think the way you're successful is when you acquire an asset is getting tenants to stay. If they're turning over every year or every 2 years, I mean, you can raise rents. That's true, but really, what you want is tenants to stay in the property and to renew their lease every year, and hopefully, over the life of the hold, you're able to up the rents some. But by building a community and encouraging the property management to build a community by having once a month tenant appreciations. And so we do that in all of our properties. There's a tenant appreciation activity once a month, very small activity, where either you're having, sometimes it's cocktail, sometimes it's back to school specials for the kids in the fall, other times it's holiday parties. It doesn't have to be extravagant. The one I love recently is our operator just decided to have donuts at the door, at the gate. I'm sorry, at the gate, as the tenants were pulling out one Friday, and they were just handing out donuts and coffee. That's just it's about a focus on operations again. When a tenant calls, they just want somebody to fix something. They don't want to wait for 2 years or 6 weeks or whatever. They want somebody there soon. And so it's having that operations focus of one, showing the tenants you appreciate them, answering their calls, giving them value. It's not a rocket scientist business. It's human relations. And so if you can develop a sense of community, you stand a much greater chance of success then, and you've heard of those stories where somebody is a slumlord and all they're trying to do, they don't take care of the property. And so it just doesn't make any sense to do that from anybody's perspective.
That's great. So can you talk about maybe some of your strategy to increase the value of the property? Because I understand that that's a pretty important aspect of owning and potentially exiting multifamily.
Yeah.
And there are different strategies. And then it sounds like you are treating your tenants right. So that's certainly great because you keep the occupancy rate high. What are some of the other strategies you use?
Yeah, because the thing about commercial real estate in the single family world, the value of the property is based upon the comps in the area, as we all know. Your
Mhm.
own home is the same way. Well, in commercial real estate, the value is simply based upon the cash flow the property generates. It doesn't matter if it's in the hood or some big new upcoming neighborhood.
Mhm.
So increasing cash flow is the sole priority. I mean, and it's really simple. You either increase revenue or you decrease expenses, or you do both.
Right.
Hopefully both. So you're always looking for venues to increase revenues. That's by improving the property. Maybe it's adding amenities such as, I don't know, a dog park sometimes is the latest thing. Adding a lot of tenants today like um, uh, smart apartments where you can control the locks and the heating and stuff from your phones. That's an amenity to add value from a tenant's perspective. Um, uh, the tech package is a big one. Adding something like covered parking or reserved parking. Reserved parking, it's amazing. You get your own spot that nobody else can park in, and
Mm.
people pay for each of these things. On the expense side, you're always looking about how to reduce expenses by still providing value. So I think the biggest one there is really property management. How are we as owners treating the on-site property management team? So we want them to be happy in their jobs, and that's going to pass along to the tenants. But expense reductions is anywhere from reducing water and utility consumption and electric consumption to there's just finding vendors constantly bidding expenses. So putting the landscaping out for bid every couple of years to make sure that we're getting the best price. In Texas, you're trying to challenge the tax assessment every year. So you want to make sure you have a good tax consultant on your side that helps you challenge the tax appraisal. So there's any number of opportunities like that. And most importantly, you're trying to partner with that on-site property management company because they're there each and every day, and you're asking them, what do you think? Where can we reduce expenses? Can we push rents anymore? And you want them to be part of your business plan very early in the acquisition.
Okay, cool. Yeah. I haven't sort of looked into this area for a couple of years. I think some of the things that you talked about are pretty new, like the technology related items, which I find very interesting. Um,
And people are paying $50 a month more for that.
oh, wow. Yeah.
It costs us like, I don't know, I'll say $300 to put it in. It's not extravagantly expensive. So
Hmm.
it pays back after about 5 or 6 months.
Yeah, that's great.
And again, you're increasing revenue.
Hmm.
So you're increasing the net operating income.
Hmm.
Therefore, you're increasing the value of the property.
Yeah. Yeah. And all that income is going to be divided by the cap rate to get to the increased value. So that's a big multiple or a
Right.
big return, I should say. Um, Speaking of, so what is the cap rate nowadays for multifamilies? What are you looking at?
Uh, that's probably the subject of another whole conversation. But cap rates are market specific, so they're not gonna be. But cap rate, generally speaking, is an indication of what an investor would pay and want. I should say what kind of return an investor would want if they're gonna invest in Sugarland, Texas, versus Cypress, Texas, because it can change within Houston, right? It's a big area. So do they want would they seek normally a 4% return or a 6% return? So cap rates are increasing. And as you know, if the cap rate increases, uh, that forces that equation of NOI over cap rate. If the denominator increases, that forces the value of the property down. So you got to fight even more income or expense growth.
Mm-hmm.
But a couple of years ago, you were seeing sub 4 cap rates. You're seeing a lot of them now in the 5 range, and some escalating even higher than that. But that is very market specific, and your investors should be able to find, if they ever entertain one of these investments, can find that out via the broker or the general partnership group that's trying to encourage investment.
Yeah, yeah. So here's my dilemma, right, or my question. So at a high interest environment, you can put your money in a treasury bill and get 5% plus return, which pretty much has no risk attached to it. Whereas if you invest in real estate, you're looking at a fairly low cap rate, I think, historically speaking. So how do you try to sell that investing in real estate is a better option than buying treasury bills?
I think you're a very smart lady, because I get that question all the time. Randy, why would I invest in this? I can get 5% risk free, and a money market fund versus 6 or 8% in a full of risk in a multifamily property. So, to me, the answer is it just depends on what your risk tolerance is. Every investor is different, and I can't refute if you want to take a 5% risk-free investment with a T-bond or something like that, T-bill. But the comeback, I would say, is to think about, depending on what your view of it is how long are interest rates going to stay that high. It can be, one would argue, it's fairly short-sighted that those interest rates are going to start coming down. 2, you don't get any tax advantage in that T-bill investment, and over the long haul, it's been proven that real estate is going to outperform most markets in the long haul, and so it's a hard asset. So 2, it's better in my mind than a stock or bond because it's a physical asset. It's a building someplace, so it's tangible. So you can touch it and feel it, and I don't think there is a right or wrong answer there, but those are top of mind thoughts.
Yeah. Plus the diversification, right? You mentioned at the beginning.
I should have said that. Thank you.
Yes. Great. So since you mentioned the long-term sort of comparison, what do you think is the long-term over the next 5 to 10 years, the trend for real estate investing? Do you think it's going to get better as interest rate comes down or more competitive?
I've been doing it for 10 years, and I don't think it's gotten less competitive anytime. I think there are so many educational arms out there putting out students, and overall, the U.S. economy is flush with a lot of cash. People are hesitant, as you've indicated, to invest it. I think for the most part, there's a lot of cash sitting on the sidelines. Overall, I'm still very bullish on multifamily. I have about 35% of my net worth in various multifamily projects, either as a general partner or as a limited partner. And that's growing, I might add, for me personally. So I'm still bullish. I think it's a good place to be. And back to that portfolio diversification and portfolio, everybody's chasing yield. So you need a mix, in my mind, whether you call it real estate, alternative investments, high yield, something that's a little riskier in your portfolio to keep that average return above the inflation mark and to keep going. If you're going to get a 5% return over the next 10 years, you're not keeping up with inflation and stuff in the long run, or the interest rate. So
Yeah.
investors have to think about how they're going to keep that return going above the inflation.
So what is, you think, a ideal asset allocation if an investor is looking at things holistically? So, like, talk about you
Yeah.
personally. You said 30-40% multifamily real estate. What are some of the other assets that you invest in?
So I invest. I still have several of my corporate 401ks and stuff that I have the traditional stocks and equities mix. Foreign investment bonds, high yield or whatever. I also my own private money. I invest in other asset classes like ATMs, car washes. They're
Oh,
all syndicate. They're all syndications though.
okay.
They're all different asset classes. Probably the topic of another interview sometime.
Yeah.
Why I like those. But to answer your question, really, what's the portfolio mix? So I'm 35%. I've got friends that are 100%
Mm.
in real estate. I'd go back to my corporate world. That 1.5 billion endowment, they had anywhere between 8 and 12% of the portfolio in real estate. So as I have some high net worth investors, and they've asked me that same thing, and I said the answer is really wherever you're comfortable at. I like it. I understand it. If you like the Warren Buffett methodology of he doubles down on stuff he knows and likes, he would say that diversification is for losers sometimes. He hasn't said that exactly, but he doubles down frequently on something that he understands and he likes. So I want to get to about 50% of my portfolio in multifamily. But somebody else that owns a home and says that's all they want, I think I would encourage them to think of it a little broader than that. And so my high net worth friend, I'm trying to get him comfortable with 8 to 12%.
Yeah. So, I mean, speaking of Warren Buffett, I think I agree. He doesn't advocate for diversification. He has kind of adopted the approach of finding the businesses that he can really understand and hold a few of them. But he's also well known for not liking real estate as an investment, because I think, according to him, real estate is just rarely mispriced. Whereas in the stock market, you can find opportunities more easily because they fluctuate so much, whereas their intrinsic value doesn't necessarily fluctuate as much. So you can find opportunities where it's clearly mispriced because the market is short term focused and so forth. But anyway, it doesn't necessarily mean that it contradicts with what you were saying, right? Because you have to invest in things that you understand. So that's kind of the key principle there.
Well, Warren said it wasn't but 10 years ago. I remember Warren said he never would invest in technology stocks.
Yeah, and then
Today, he's very heavily in
mhm,
technology stocks.
yeah,
So it's all about, as you said, education and your risk tolerance level.
yeah, yeah. So how do you find deals nowadays? Because you mentioned it's going more and more competitive. That trend is not reversing anytime soon. How do you kind of stand out to get deals?
Well, I think my short answer goes back to that team concept. So it's constant networking, constant education. I still listen to all kinds of real estate podcasts. I'm a nerd. I read the real estate books and go to go to seminars and meetups and things like that. So it's staying apprised, and I think it's finding specific markets that you're comfortable in,
Mhm.
whether it's Houston, Texas, or Ann Arbor, Michigan, or any place in between, and focusing on those and building your team is really important, I think. So I've had deals come to me. I've found other deals that somebody had. The Tucson one, my example, the gentleman came to me, the partner, and said, "Hey, would you be interested in joining?" I jumped on that. Didn't let the ink dry in the offer because I love that market. So there's not a single way. I get asked this question all the time: how do I find deals? You got to develop broker relationships. You got to stay in touch with brokers in those specific markets you like, so that brokers will bring you deals, hopefully, or friends at meetups, conferences will bring you deals while you're looking yourself. Join those educational groups, join those masterminds. You're going to spend a few dollars, but it's worth it.
Yeah.
It's the old cliche that your network is your net worth.
Yep. I've definitely heard of that saying before, and I thought that was what you were going to say. It's probably going to be a tangent, but there was this lawsuit where real estate agents got challenged on the commission they charge. Does that impact commercial real estate brokers at all, or it's completely a different?
Commercial real estate is generally a negotiated price from the beginning. So to my knowledge, I'm not the expert, but to my knowledge, that lawsuit was really around the single families selling. But commercial real estate is really negotiated from the beginning.
Okay.
Generally, the seller pays it, but it can be anywhere from, when it's a $30-40 million property, it can be a percent. Smaller properties are going to have 2, 3, 4% commission fees, but obviously it doesn't take a rocket scientist to understand the difference between a 4% at 20 million or 6% for a $300,000 house. So,
all right, sounds good. And do you have any advice for aspiring investors who want to get into the multifamily investing space?
well, the advice is to stick with it. It's a marathon. It's not a sprint. Don't become discouraged because you haven't got a property in 6 weeks or you didn't find a partner. Again, mine was a 10-year run. It's easy for people to look at me to say, how do I replicate that? Well, it took me 10 years. So it wasn't built overnight. Take the long-term view, continue to educate yourself, continue to network, and just stay at it. If somebody told me, Handy, this isn't a brain surgeon industry. It's follow the playbook of those that have gone before you. and it's just that. Follow the playbook of those that have gone before you. Yep. It may take, I don't know, somebody 15 years. Somebody may be able to do it if they've got a big balance sheet in a year. But I really try that because I was that way for a long time. I got really discouraged, blah, blah, blah. Just take the long view is the short answer, and continue to educate yourself.
Yeah, that's great. So then for the people who are looking for more of a passive route to invest, do you have some advice on how they should vet the general partners, how they should vet the deals? What's your advice?
Contact me. I got I got 20 questions I can give them to ask the general partnership. But first and most importantly, it's you invest with those you know, like, and trust. So get to know them, not just on a deal, but as individuals if you can. That may take more time, but I try to cultivate relationships over 6 weeks or 2 years before anybody invests, to keep them apprised of Randy and my company and the opportunities I'm looking at. And some of them never invest. And I got a call just the other day of a guy hadn't talked to in a while, saw the opportunity I'm looking at, build to rent, and wanted to plop down a sizable sum, which I was pleasantly surprised. But it's about relationships is the biggest thing I would say. Then you got to decide whether I get people, like I said, that want to just plop down money that have no interest in understanding the analytics of the deal. They're simply asking, what's my return? And then there's other investors that want to understand the analytics of the deal. How is it underwritten? What's the business plan in great depth? Neither of those are wrong. I tend to encourage people that want to be passive investors. There's really no such thing as a passive investment. There's less active than others. And once like I have people that I've worked with as a passive investor, if I've got money and they send me a deal, I'm just going to invest. But
Mhm.
it's because I've done 3 or 4 deals with them and we've had a relationship, and it started with a very detailed conversation with them, asking them a lot of questions. And if somebody's not willing to spend the time with you to answer those questions, that's a giant red flag in my mind.
Mhm. Mhm.
If you're a first time investor, and you should have a lot of questions, and if somebody's not willing to spend the time with you, that's a problem.
Mhm.
I'll
Yeah.
make sure they're doing that. And trust me, I've been doing this for 10 years, like I said, and I get more opportunities in my inbox today than I can invest with. And people say, how do you challenge a good deal from a bad deal? Well, first, as we said, for me, it's the sponsorship or the general partnership group. Do I know them?
Mhm.
You know, so I can get an email with, here's an opportunity in Topeka, Kansas for 25% IRR and a 10% cash on cash. Well, I don't know them at all. And maybe
Mhm.
they've got a great track record, but, and I'm not calling them a liar. I'm just saying, I don't know them.
Mhm.
I'm
Yeah.
not going to invest with them, but um, I can maybe someday. So
Yeah.
get to know the sponsorship group, begin to understand the analytics, and begin to develop your list of questions.
Mhm.
Don't just give them money because you like it. You like them.
Yeah, that's great advice because personally, I feel like I'm having the consequence now of not vetting enough when I got into this syndication deal. I started in 2018, so the term is coming to an end, but they're having a hard time selling the property now because I think the interest rate has gone up, and then they couldn't really sell it at the price that they want
Mhm.
to sell at. And then for some reason, I think the rent collection hasn't been going well. So it seems to be having all sorts of problems now. Back when I started the deal, there was no way probably to foresee that the interest rate environment is going to change, I guess, so
Right.
drastically, because nobody knew that there was going to be a pandemic and then the consequences thereof.
You hit on another great argument. So back when I first started, if somebody had a deal that went sour, that was a big automatic, you know, they were kind of barred for life from ever doing anything more. You're in deals like that. I'm in deals like that. They're not bad yet, but they're not meeting the pro forma standards. And as you said, very few people ever predicted the interest rate rates we've had, um, COVID-19, et cetera, et cetera. So I don't necessarily think that you did a bad job. I don't know any of the deal parameters at all, but it's just the market cycle we're in. There are some very strong operators that I'm aware of that have given properties back to the bank,
Oh, wow.
not because of something they necessarily did wrong. Maybe it was, but a lot of times it's just that part of the cycle from
Mhm.
like 2011 through 2022. Everybody was making money,
Mhm.
doing deals. Uh, those days, I don't know if they'll ever come back, but I still think there's money to be made for the savvy investor.
Mhm. Mhm.
And I don't know your deal at all, but don't give up on that either.
Okay.
Um, and so maybe unless instead of making 100%, maybe you only make 20%.
Mhm. Yeah. Well, they're still trying, so maybe hopefully if the interest rate comes down,
Yeah.
towards the end of this year or next year, maybe they will find a acceptable buyer. So, all right, great. So, two more questions for you. Do you have any book recommendations? You mentioned you read a lot. So, what are some of the best books you want to
I'm
recommend?
not in my home office. Passive Investor by Brian Burke, I think it is. Let me find it and send it to you so you can put it in the show notes.
Sounds good.
Would be the one I would top of mind because
Mhm.
back to that, what do passive investors need to know? He outlines every risk imaginable to man,
Mhm.
um, and it's a great book. And I digested it and gave it to several of my
Mhm.
passive investors. It's a gift.
Nice, nice. Okay. And then last question, where can people find out more about you?
Handy, at first, it's really been a pleasure getting to know you and talking
Yeah,
to your
likewise.
audience.
Uh-huh.
And so they can get hold of me real easy. Social media, Facebook, LinkedIn. I'm sure we'll put this stuff in the show notes.
Yep. Mhm.
My my corporate webpage is invest-ark.com.
Mm-hmm.
And my coaching mentoring business is Multifamily Maestros, all one word, multifamilymaestros.com. And both of those have a contact me on there. Love to chat with anybody in your audience that wants to talk about real estate.
That's awesome. All right, great. Thank you so much, Randy. This has been really helpful and interesting. Thanks so much for your time.
Thank you, Andy. It's great to see you.